He cracked the market decades before computers ever existed. His name was Goichi Hosoda, a quiet genius who built a system so complete it still guides professionals to this day. Ichimoku Kinko Hyo, a trading framework designed to spot trends, confirm entries, and filter out fakeouts with surgical precision. And now, you're about to learn how to read it like a pro, even if you're just starting out. Now, watch closely, because here's what you're about to unlock. Before we dive into the heart of the Ichimoku system, take a moment to like the video, subscribe to the channel, and tap the notification bell so you never miss a high-level trading lesson like this one. Now, let's get started. Let's start by setting up the Ichimoku indicator on your chart. If you're using TradingView or any major charting platform, just go to the Indicators tab, type in Ichimoku, and select Ichimoku Cloud. Once you apply it, your screen lights up with a storm of lines. And yeah, I know, at first glance it looks like chaos. But here's the truth. You don't need to memorize every single line to trade effectively with Ichimoku. Let me break it down. The default Ichimoku setting gives you 5 key lines. First, the Tenkan-sen, also known as the conversion line. Next, the Kijun-sen, that's the baseline. Then you've got the Chikou span, this one is the lagging span. And finally, the 2 lines that form the cloud. Senkou span A, which is the first leading line, and Senkou span B, the second leading line. These 5 elements work together to give you a full view of trend, momentum, and potential support or resistance, all in one glance. Most beginners get overwhelmed trying to track all 5 components at once, but here's a key insight. The real strength of Ichimoku lies in the Kumo, also known as the cloud, that space between Senkou span A and B. This cloud is where the equilibrium battle between buyers and sellers happens. It acts as a multi-dimensional zone of support and resistance, far more powerful than a single line. So if you're just starting out, here's what we recommend. Hide all the other lines. Tenkan-sen, Kijun-sen, and Chikou span. Keep only Senkou span A and Senkou span B visible. These 2 lines form the Ichimoku Cloud, and that's where your focus should be in the beginning. This setup cleans up your chart, removes conflicting signals, and helps you master the heart of the system before moving on to more advanced strategies. Now, let's break down how the Ichimoku Cloud, or the Kumo, is traditionally used. There are plenty of interpretations out there, but we're going to focus on what actually works, the methods that give you clarity, structure, and reliable signals. First, use the cloud to define your directional bias. When price is above the cloud, it typically signals a bullish market. Buyers are in control. When price is below the cloud, it suggests a bearish market. Sellers are dominant. Second, gauge momentum by the distance from the cloud. In an uptrend, the further price moves away from the cloud, the stronger the bullish momentum. When price starts moving closer to the cloud or enters it, momentum is fading, and consolidation or a pullback may follow. In a downtrend, the further price is below the cloud, the stronger the bearish momentum. As price creeps back toward the cloud or trades inside it, it signals weakening bearish pressure. Third, watch for cloud breakouts as trend reversal signals. When price breaks through the cloud, it can confirm a potential trend change. In an uptrend, price is comfortably above the cloud, trend is bullish. But once it breaks below the cloud, that's a major red flag. It often signals the transition from an uptrend into a downtrend. Let me show you a chart example. This is the US dollar, Canadian dollar on the daily time frame. The market had been trending strongly to the upside, staying above the cloud, a clear signal of bullish momentum. But once price entered the cloud, that strength started to fade. And after breaking below the cloud, the trend completely reversed, shifting from a bullish uptrend to a bearish downtrend. Let's look at another chart example. This time, it's the Australian dollar, Japanese yen on the daily chart. The market had been trending above the cloud, which signals a clear uptrend. But right after price broke below the cloud, the trend shifted direction, turning from bullish to bearish. The same rule applies in reverse. In a downtrend, price will stay below the cloud, that's bearish. But when it breaks above the cloud, that's your potential signal for a trend reversal to the upside. Take a look at the Euro-US dollar daily chart. The market had been in a downtrend for months, but once price broke above the cloud in March, the trend flipped, and it kept climbing all the way through July. So if you were just using the cloud, you could have spotted that trend reversal before most traders did. Now take a look at another chart. This time it's from the stock market. We're looking at advanced micro devices. As you can see, the stock was trending below the cloud for quite a while, signaling a clear downtrend. But right after it broke above the cloud, the trend flipped, and it's been moving higher ever since. That breakout happened in May, and from that point up to the day I'm uploading this video, the uptrend has held strong. These cloud breakouts aren't just technical, they reflect a shift in market psychology. Price breaking through that zone of equilibrium shows that either bulls or bears are losing control. And remember, trading inside the cloud is dangerous. That's where the market is imbalance, indecisive, and often choppy. Most Ichimoku traders wait for price to clearly break above or below the Kumo before committing to a trade. Now let's move into one of the most practical and powerful uses of the Ichimoku Cloud, using it as dynamic support and resistance. When price is above the cloud, that indicates a bullish bias. If price pulls back toward the cloud, observe how it often respects the outer edges of the cloud. These boundaries act as dynamic support zones. Price may bounce right off the top of the cloud, or sometimes even dip slightly inside the cloud before reversing. Either way, the cloud acts as a cushion, a zone where bulls can step in and drive prices higher. These pullbacks create high-probability long trade opportunities, especially when supported by bullish candles or confirmation patterns. Now, let's flip the script to a downtrend. When the price is below the cloud, the market is bearish. If price pulls back up toward the cloud now acts as a resistance zone. You'll often see price stall at the bottom edge of the cloud or even poke inside briefly before reversing back downward. These reactions set up clean short opportunities, especially when multiple candles reject the same level. The reason this works so well is because the Kumo isn't a static line, it's a zone of equilibrium, constantly adjusting based on prior volatility. That makes it a more realistic and powerful form of support and resistance than traditional horizontal levels. Now here's a powerful setup you can trade. Combine a cloud breakout with a cloud pullback entry. For example, price is in an uptrend trading above the cloud. Then price breaks down through the cloud. That's your trend change confirmation. Shortly after, it pulls back up to retest the bottom of the cloud, which now acts as resistance. You see multiple rejection candles showing hesitation at that level. That's your short entry opportunity, with the benefit of catching a new bearish trend as it begins. What makes this setup high quality is timing. You're entering right at the start of a fresh trend, which usually has room to run. There's still gas in the tank. And just like that, we can apply this in the opposite direction too. Price is in a downtrend, trading below the cloud. Then it breaks up through the cloud, signaling a potential trend reversal to the upside. After the breakout, price pulls back into the cloud, now acting as support. You see a long wick candle, a sign of buyer strength and rejection of lower prices. That's your long trade opportunity, especially once you get intraday confirmation that the market is starting to move higher. The psychology here is powerful. The market has just flipped direction, broken above equilibrium, and is now testing that same zone as support. And if it holds, that gives you the confidence to ride the next leg up, catching the start of a fresh uptrend with momentum on your side. For example, the market was trending down, hit this level, and reversed, forming a support zone. That level became a key area of sell-side liquidity. Price then pushed up toward the cloud but got rejected. When the market came back down and revisited that same support zone, it broke below it but then immediately closed back above, creating a clear liquidity sweep. That's your signal. You can enter at the candle close that confirmed the sweep. Place your stop loss just below the low of the sweep. Your target? The cloud. Now remember, when price reaches the Ichimoku Cloud, there's a high probability of a rejection. Why? Because the cloud often acts as dynamic resistance in a downtrend. Look at what happened next. As you can see, price reached the cloud, and although it showed signs of bullish momentum, this is where many traders decide to take profits. Why? Because even though the market could push higher, this is a smart place to exit and wait for another clean setup, rather than getting caught in potential consolidation or a reversal. Before we jump into the Ichimoku strategy section, here are 3 key points to remember. Number 1. Like all indicators, Ichimoku should never be used in isolation. Indicators give context, not certainty. Relying solely on the cloud without price action confirmation will lead to false signals and unnecessary losses. We use Ichimoku only to confirm high-quality trade setups that are already supported by strong structure, trend, and price action behavior. Number 2. Everything we're showing you, from the way the cloud works to the strategies we'll cover, applies to all asset classes. Whether you're trading stocks, crypto, forex, commodities, or indices, Ichimoku works the exact same way. It's not asset dependent. Number 3. These strategies also work across all time frames. You can use them on the 5-minute chart for scalping, the 4-hour chart for swing trading, or even the daily and weekly charts for long-term positions. Let's start with our first Ichimoku trading strategy, and it's a classic, the pullback strategy after a cloud breakout. This setup allows you to join the new trend after it's already confirmed by waiting for price to pull back into a key level from the past. It's simple, structured, and works on any time frame. Now let's walk through the first example. A bearish trade where support becomes resistance after a cloud breakdown. The market was trending up, trading nicely above the cloud, showing bullish control. Then things start to shift. Price begins to pull back, enters the cloud, and eventually breaks below it. It then moves back up to retest the cloud, which now acts as dynamic resistance, and from there the market continues downward. This is a clear sign of a trend reversal, from bullish to bearish. Once price is below the cloud, we switch our mindset. We are now in a downtrend. The next step? We look to the left side of the chart to identify a previous support level, a point where price bounced earlier during the uptrend. This level is now important. Since the trend has turned bearish, that old support becomes new resistance. So we wait for price to pull back up into that level, and when it gets there, we watch for a clear rejection, like a bearish engulfing candle or a long upper wick. In this case, price reaches the resistance, tests it, and then gets firmly rejected. That tells us sellers are stepping in to defend the level. This is our short entry signal. Now, before entering, we want to check the higher time frame to confirm the trend. Since this example is on the 15-minute chart, we jump up to the 1-hour chart. On the 1-hour chart, the market was trending upward. Price was trading above the cloud and forming higher lows. But as you can see here, the market failed to respect the cloud, which had been acting as dynamic support. It entered the cloud, signaling a possible trend reversal on the hourly time frame. This supports our trade idea on the 15-minute chart, where we can catch the start of the new downtrend from the very beginning. It aligns perfectly with our setup. So now we go back to the 15-minute chart and place the trade. Entry: at the close of the bearish rejection candle. Stop loss: just above the resistance level. Target: the next major support zone. Look what happens next. Price rejects the level and falls sharply, hitting our target. Now let's look at the opposite scenario. A bullish setup. The market starts in a downtrend with price trading below the Ichimoku Cloud. Eventually, price begins to recover. It moves up, enters the cloud, and finally breaks out above it. That breakout is your signal. The downtrend is likely over, and we're shifting into a new uptrend. So what's next? We scan the chart and find a previous resistance level, an area where price was rejected in the past. Here we've now broken above it. This resistance is expected to flip into support. And that's exactly what we wait for, a pullback into that level. Once price returns to the zone, we look for a bullish rejection, a long lower wick, a bullish engulfing candle, or any clear sign that buyers are stepping in. Now let's move up to the higher time frame, the 1-hour chart, and take a look at the market structure. The market was ranging at first, but then it made an initial move upward, followed by a pullback and another push higher. This sequence signals the start of a potential new uptrend that supports our trade setup. That gives us solid confirmation for our trade idea. Back to the 15-minute chart. Entry: at the close of the bullish rejection candle. Stop loss: just below the support level. Target: the next resistance area or recent swing high. Look at what happened next. As you can see, the market reached our target. Now keep in mind, this strategy isn't a holy grail. It's a solid, high probability trading strategy, but like any approach, there will be losing trades. That's why proper money management is absolutely essential if you want to succeed over the long run. Alright, let me show you a powerful trend following strategy that combines the Ichimoku Cloud, the 21 and 50 simple moving averages, and pure price action to help you catch institutional moves with clarity and confidence. This is a trend-following strategy. We'll use the Ichimoku Cloud to identify the trend, the 21 and 50 SMAs as dynamic support or resistance, and candlestick patterns to enter with precision. Let's break it down. First, we look at the Ichimoku Cloud to determine direction. In this example, the price is clearly trading below the cloud. That tells us the market is in a downtrend, so we're only looking for sell opportunities. But here's the key. In a strong trend like this, waiting for price to pull back to a static resistance level like a horizontal line might keep you waiting forever. The market doesn't always give you a clean retracement. Instead, we use the 21 and 50 moving averages as dynamic resistance. These moving averages move with price and act like magnetic zones where institutional orders are likely to be sitting. Let's look at this chart together. Here, the market pulled back and got rejected, forming a bearish engulfing candle, a strong opportunity to enter the trade. Later, the market pulled back again and formed a pin bar. If you missed the first entry, this pin bar gives you another chance to join the downtrend. The market then pulled back once more and formed a doji, signaling potential continuation of the bearish move. That's yet another opportunity to trade in the direction of the downtrend. Each of these setups gives you a clean opportunity to ride the trend, without guessing and without waiting for levels that may never come. Now let's flip the script and look at the same strategy, but this time in a bullish market. The concept is identical, the only thing that changes is the direction. The Ichimoku Cloud still gives us the trend, the 21 and 50 simple moving averages still give us the dynamic entry zones, and candlestick patterns still give us the signal, but instead of looking for rejections from above, we're now watching for bounces from below. In this example, price is trading above the Ichimoku Cloud. The cloud is bullish, Senkou span A is above span B. Both Tenkan and Kijun are angled upward. This is a strong uptrend. So what do? We wait for pullbacks into our dynamic support levels, the 21 and 50 simple moving averages. We don't wait for price to return to static support. It may never happen. We let the moving averages guide us, just like institutions do. Let's break it down. First, price pulled back to the 50 simple moving average and got rejected. A great opportunity to enter the market and join the uptrend. You can see another rejection here and another one here. When we use the 21 and 50 simple moving averages as dynamic support in an uptrending market that's trading above the Ichimoku Cloud, we get multiple entry opportunities. Now you know how to combine cloud pullbacks with the 21 and 50 moving averages. Just remember, always check the higher time frame before entering a trade. That way, you are trading in alignment with the overall market trend. That's a wrap on the Ichimoku Kinko Hyo system. If you found value in this lesson, like the video, subscribe to the channel, and hit the bell so you never miss a powerful trading strategy. Thanks for watching, and I'll see you in the next one.